Welcome to The Explainer. Today we're diving into a topic that could be a massive deal for any business owner in the UAE, how to sell your company and potentially save a huge amount of money by legally avoiding VAT on the deal.
So, you're thinking about selling your business. I mean, that's a huge moment, right? You've poured your heart, your soul, everything you've got into building this thing. And now you're ready for what's next. But hold on. Before you start celebrating, there's a pretty big financial detail you just can't afford to ignore, and that's taxes.
Specifically, what about the value added tax, on every single asset you're about to sell? Just to put some numbers on it, let's say your business is worth 2 million dirhams. A 5% VAT charge on that, that's 100,000 dirhams. Gone. That's money that really should be in your pocket, not the government's.
But what if I told you there's a way to avoid that tax nightmare? It's called the Transfer of a Business as a Going Concern, or TOGC for short, and it is a real game changer in the UAE VAT law. So today, here's what we're going to cover. We'll look at the VAT problem, this awesome TOGC exemption, the difference between an asset and a share sale, the 3 critical conditions you have to meet, and finally, what everyone's obligations are in the deal.
Okay, let's get right into it. To really understand why this TOGC thing is such a big deal, we first need to look at the default situation. What happens if this special rule doesn't apply?
Well, under the standard rules, the tax authority doesn't see you selling one business. It sees you selling hundreds of little things. That desk, that's a taxable supply. The computers, taxable. Every piece of inventory, you guessed it, subject to 5% VAT. It all adds up incredibly fast.
Thankfully, the law provides a much smarter solution. It recognizes that when you're selling an entire functioning business, well, that's a completely different animal than just selling off a pile of assets.
And this is the absolute heart of the matter. A TOGC isn't just a sale, it's more like a transplant. You're taking a living, breathing business and moving it from one owner to another with the full expectation that it's going to keep on running just like before. And here's the magic. A TOGC is considered to be outside the scope of VAT. It's not zero-rated or exempt. Those are totally different things. It's simply not seen as a supply in the eyes of the VAT law. And if there's no supply, there's no VAT. It's really that simple. Now, before we get into the nitty-gritty of how you qualify for this, there is a really important distinction we have to make. These TOGC rules only apply to a specific type of asset sale, and that is fundamentally different from selling the shares in your company. Think of it this way. A share sale is like selling the title to your car. The car itself doesn't change, just the name on the ownership papers. But an asset sale, a TOGC, is like transferring the engine, the chassis, the goodwill, the customer lists, all the essential components that make the business run to a new owner. You're transferring the business itself, not just the company that holds it.
And this really drives home the point. You have to work through this logically. First you ask, am I selling shares or assets? And then, if it's assets, you have to ask, is this just a regular sale, or does it have all the special characteristics of a TOGC? Getting this first step right is absolutely crucial.
So, you figured out you're doing an asset sale. Awesome. The next huge question is, how do you make sure it gets that special, outside the scope of VAT treatment? Well, the answer lies in meeting 3 non-negotiable conditions. Think of this as your essential 3-point checklist. Number 1. You have to be selling a real operational business, not just a bunch of stuff. Number 2, the buyer has to be part of the VAT system already. And number 3, the buyer has to genuinely intend to keep running the same business they just bought. You cannot miss a single one of these. So let's just zoom in on that second condition, because taxable person has a very specific meaning. It means the buyer either is already registered for VAT, or they're required to register and have already applied, or they've applied for voluntary registration and been accepted. The key is their VAT status has to be sorted at the time of the transfer.
All right, let's put this to the test. Imagine a manufacturing company decides to sell just its factory building. They're keeping the machinery, the staff, the customer contracts, everything else. Does this sale qualify for TOGC treatment?
The answer is a hard no. And the reason is simple. It fails the very first condition. A building is just a building. You can't run a manufacturing business with just 4 walls and a roof. This is a simple property sale, and it would definitely be subject to VAT.
Okay, but let's tweak the scenario. What if the seller is transferring not just the building, but all the specialized equipment inside it, and the contracts with their suppliers and customers? Does that change things?
And here is where you see the power of the TOGC. Yes, this now has a strong chance of qualifying. Why? Because the buyer is getting everything they need to walk in the next day and continue making and selling the same products. It's a complete operational unit. As long as the other two conditions are also met, you're likely looking at a TOGC.
So, you've successfully navigated the 3 conditions, and your sale qualifies. That's fantastic, but it's not quite time to celebrate yet. Both the buyer and the seller have specific obligations they need to know about.
For the buyer, the most important thing, and we've said it before, is getting their VAT status in order at the time the transfer happens. This is the absolute foundation of the whole TOGC treatment. It is critical. And for the seller, you've got to remember, the TOGC is not a magic wand that erases your past tax liabilities. It only applies to the transfer itself. Any VAT you owed from running the business before the sale, that's still on you to settle. And here's a fascinating detail that often surprises people. While the buyer's VAT status is critical, the seller doesn't actually have to be registered for VAT. The law is really focused on making sure the business continues to operate within the tax system under its new ownership. It's an interesting quirk, right?
So, when it comes right down to it, the TOGC rules are about more than just taxes. They force you to ask a bigger question. Are you just selling a collection of assets? Are you passing on a living, breathing business legacy? Understanding that distinction is the key to a smooth, successful, and tax-efficient sale. So before you sign on that dotted line, make sure you've done your homework. It could be the most profitable decision you make.